If you are a newer dividend growth investor, your main complaint about dividend growth investing as a strategy is probably that you're not receiving enough dividends for the money you have invested or enough buck for your money. I get that. In this video I will show you, with my own portfolio as an example, that with a hybrid approach you can get the best of both worlds. Immediate dividend income, but also dividend growth to keep beating inflation in the future. My dividend portfolio has a near 5% yield on cost, near 6% yearly dividend growth and on average double-digit yearly total returns. Stick around until the end because I will reveal my dividend portfolio in detail, how much dividends I received this month and all that juicy stuff. Take a company like T. Rowe Price. When I bought it in 2017, on the surface this does not look like a good deal if you want to generate passive income in the form of dividends. For every $1,000 invested at that time, I only received about $31 per year. Even worse with the mere 6 shares I bought, as that only accounts for $13.1 in passive income. It's not even enough to pay for Netflix subscription, let alone support your lifestyle. Or Johnson & Johnson that I bought on that same day in 2017, with a yield of only 2.6%. That stock only paid me $26 per $1,000 invested and not even $10 for the 3 shares I bought. The same with Williams-Sonoma, like $29 per $1,000 invested or $12 for the 8 shares I bought at the time. Then we have a stock like Omega Healthcare Investors, ticker OHI. I bought 66 shares of OHI for about a 9% yield in 2017 and at the beginning of 2018. With that kind of yield we are already getting $90 per year for every $1,000 invested. With the 66 shares I bought it is even more at $161 per year. That looks a lot better, doesn't it? Or what about Tanger factory outlets that I bought for 8.9% yield at the beginning of 2020? And with the 56 shares I bought that added $79 to my yearly dividends. Why didn't I just buy 10 or 20 more of those companies with a 9% yield? If income from dividends is my goal, right? It would get me to my goal of 30k in annual dividends much quicker. This is why. A 60% price drop and a dividend cut. Companies with a higher yield usually have a higher yield because they bear more risk. Risk of cutting the dividend and with that usually a big drop in prices as a result. Tanger factory outlets, ticker SKT, was and is struggling with the retail apocalypse that started with the rise of Amazon, where online retail becomes more appealing to customers. Which would mean less traffic for outlets like those of Tanger. Obviously I believe that won't play out like that and there is still a place for the outlets of Tanger. But then the pandemic came and the dividend was still cut and the price dropped 60+%. Not for the faint-hearted, I would say. I did not sell and I actually regret not buying more when they were down. Or what about Omega Healthcare Investors? They also dropped in price due to the pandemic. What stock didn't, right? But did not cut their dividends. But Omega Healthcare Investors also has not raised their dividends for a while. They are a REIT, so basically a landlord to their tenants, which are healthcare operators. Some of those operators are struggling and with that are struggling to pay rent, meaning less rental revenue for Omega Healthcare. So we got a high yield but no dividend increases. If this persists, long term, inflation will eat up my high dividends. If I assume a positive outcome for both, and they will eventually start to raise their dividends again and I would expect not more than 2% increase per year in dividends, plotted out the dividend income in 10 years would be like this for both companies with a $1,000 investment. OHI would be $157 per year in dividends with those assumptions and reinvested dividends after 10 years. Tanger at $70. That is a 15.7% yield on cost for OHI. Because Tanger had cut its dividend before, the current yield is much lower than that of Omega Healthcare and that shows. So again, why would you or me not just invest in 15 to 20 more of these stocks, right? Let's get back to those companies like T. Rowe Price, Johnson & Johnson and Williams-Sonoma I mentioned at the beginning. The ones with low immediate dividend income at the time I bought them. But first a little bit about me and this channel. Hi there, I'm Tom from the Dividend Attitude Show. On this channel I make videos about dividend stocks, whether it be dividend stock battles or dividend stock analysis on an individual company. And once a month, to track my progress and be transparent, I show an update of my portfolio, just like this one. At the time of recording we were getting awfully close to that 1000 subscriber mark, so if you want to be part of a growing community and receive notification as soon as a new video comes out, make sure to subscribe to the channel. So, T. Rowe Price, they were paying me $13 per year in 2017. 4 years later I get almost $26 for those same 6 shares. Johnson & Johnson, did I get about 10 in 2017, now I receive almost $13. Still not great of course, but with their 50 plus years of dividend increases, a very reliable dividend payer. Williams-Sonoma, $12 in 2017 and now almost $19 for those same 8 shares. If we focus on just T. Rowe Price, make some assumptions and again plot it out over 10 years together with OHI, we get this. After 10 years from today, T. Rowe would be paying me $70 per year and OHI $157. You might be thinking, Tom, I still don't see why I would not just buy only higher yielders like Omega Healthcare if I want dividend income. And I understand that, but let me show you this. After 22 years we get to the crossover point where the lines of T. Rowe and OHI start to inverse. T. Rowe is pulling away fast and after 30 years we would be paid almost $860 in dividends. That is almost the same as our initial investment every year. OHI would be at $517. That is a $350 per year difference. Ouch. And it only gets worse as time goes on. I know most of you are in a 30 to 35 age range, so the same as me. So why bother to look so far out in the future, right? If we were to invest only in high yielders, we would start to lose out on significant dividend gains in our 60s. Seems like a lifetime away, I know. But I don't want to start to lose out on dividend increases in my 60s, when I might have another 30 years to go. And I want to pass on my portfolio to my daughter, who hopefully has a lifetime ahead of her. So this is why I have a hybrid approach to dividend investing. I want sufficient immediate dividend income, but also companies that help me to get that dividend snowball to roll faster. With that said, let me show you how much dividends I received in April. Bank First paid me $3.77, Cisco paid me $5.58, and Store Capital paid me $5.89. For a total of $15.24. Life-changing money, I know, right? Quarter over quarter that is a 14% increase and year over year a 177% increase though. Not bad. This month I bought 5 more shares of Enbridge and that brings my total forward yearly dividends to $547. Compared to last month another increase of $14. That $547 gives me 13.7 hours of free time. Based on a $40 hourly wage. Since I want to generate passive income, how much did that $547 give me per month, day, hour, and so on? My monthly average dividend income is now $45.6, per day about $1.52, and per hour 6 cents, 24/7 for not lifting a finger. And here is my complete portfolio, where you can see my hybrid approach in action. I have higher yielding companies with lower dividend growth, like Omega Healthcare, Tangier Factory Outlets, and so on. But also my recent purchase of Enbridge with 7% qualifies. On the other end, I have companies with higher dividend growth, like T. Rowe Price, Williams-Sonoma, and my recent purchase of Visa. In between, I also have some with a medium-high starting yield and medium dividend growth rates, such as General Dynamics, Store Capital, and Bank First. This results in a dividend portfolio that spits out $548 in dividends, had an average dividend growth rate of 5.8% in the previous 12 months, and has gained 50% in 4 years, to now over $16,000. With a cost of $11,500, this equates to an almost 5% yield on cost. Are you looking for higher income dividend stocks? Check out the video on the right for 5 examples that give you higher dividend income. I'm off until next week. Bye bye.